expectation that they will avoid the wrath of Donald Trump.
Yeah, and you see the shares rising on earnings day. But we've had this conversation with the CEO on this program that even with this, push to bring manufacturing back to America, there's certain industries that just don't exist here. So
yeah, and won't exist, right?
Exactly.
He has said, and we've talked to other CEOs. I think Brooks, the shoemaker, was saying the same thing.
Right.
They're not. Like, it doesn't matter if tariffs are 100%. They're not going to bring that production back to the U.S.
And frankly, the trade deficit is steeper nowhere else than with China. And that's kind of the elephant in the room here. Closing that gap would take a lot. There are winners here, though, as this is all being sorted out. One question is how much more room gold has still to run.
Well, uncertainty there, but obviously the flight to real gold, not digital gold, has been playing out. Spot gold up more than 46% in the last 12 months. That's beating the S&P 500. Another area we're keeping an eye on are dividend stocks. When you look at the iShares ETF, ticker DVY, total return over 12 months, barely trailing the S&P 500 and the NASDAQ 100, despite all of the expectations around AI. So you are seeing other pockets of the market, a flight to safety continuing to play out, just given if you're trying to outperform and you're seeing maybe the S&P 500 equal weight index getting a bit of a bid, trying to find other areas. Can I just ask, when you talk to investors, do they assume that these steel tariffs, scheduled, I think, for March 12th, are actually going to go into play? I mean, the people I talk to view tariffs as a bargaining tool, and they think that the dates are going to continue to be pushed off. But if you're investing and managing a book actively, you have to at least have some form of kind of value placed on what the president is saying. And that's why you see some of these sharp moves when you look at what we saw recently with U.S. Steel and other steel makers, aluminum companies, because there is that uncertainty. And whether you were short the stocks and are covering those positions or just trying to scale into a position on the expectation that maybe they do come to fruition. But I do think, at least from my conversations, I don't know about you guys, it still is seen kind of as a bargaining chip that Donald Trump uses to eventually kind of lower expectations and chalk up some form of a win.
Well, let's ask an investor that right now. Bailey Lipschultz, really jack of all trades. Appreciate your time. Let's keep the conversation going with Nimrit Kang. She is Northstar Asset Management Chief Investment Officer. And Nimrit, weigh in here. I mean, the consensus out there seems to be that these tariffs, these threats that we get, seem to be negotiating chips for Donald Trump. But as an investor, how are you viewing them? How do you respond to them, if at all?
Today's market reaction would tell you that the market is really thinking that these are nothing more than negotiating tactics at this point. The reaction is, yeah, we've seen it. There isn't much room here on the CPI, PPI, and inflation's already running hot. Not much to do there. For us, we are in this period of extreme political regulatory disruption. And that's on top of what we're used to living with, which is the technological disruption, all related to AI. And our playbook in this kind of environment, Katie, is really to think a bit long term, stay diversified, use very prudent risk management to exit out of positions, get into positions, manage position sizes, and diversification. When we're talking about diversification across business models, market cap, and also on the margin going international.
I wonder, GDP growth is a positive right now, and does that change? I mean, earnings growth expectations seem to be coming down. Consensus at the end of last year was 14% for the S&P 500. David Kostin came on earlier this week and said 11%. I see you're looking at around 10%. Does that continue to come down? And do GDP expectations also start to come down, especially if this administration gets to cut as much spending as it wants?
Yeah, Matt, the tricky part is we don't really know the long-term impacts of how the DOGE actions flow through. It's one of those moments where until COVID-19 happened, we didn't really know how linked our supply chains were on a global point of view. And we feel it's kind of a similar situation here. Government is a big customer and government employees are big consumers at the end of the day. So, when we think about where we are, this radical but action on cutting different government agencies, reducing that, we don't really know how that feeds into different parts of the economy, how different businesses are impacted. And that's where we think there's a lot of cautiousness baked into. I listened to a number of earnings calls this earnings season, and especially interestingly for industrials, which you would think would be big beneficiary of reshoring, there was a lot of trepidation, a lot of cautiousness, a lot of back-end loaded guidance. Yes, we're going to look into the earnings growth, but it's not going to come until second half. And that's because we don't really know how these actions flow through to the real economy.
Speaking of the real economy, today's trade is set up in an interesting manner. I think it says something about the story under the surface. You do have the S&P 500 really erasing the morning's gains already, but what's leading it higher, to the extent it's being led higher, is consumer discretionary. And in this earnings season, you have seen some promising information come out of big consumer companies. Today, it's the likes of MGM. We've seen good news out of travel stocks. How strong is the consumer? Do you think that we can sit here in the middle of 2025, later this year, and be fooled by the strength that we're seeing today? Is this a fading phenomenon?
It's definitely a two-tiered economy. I mean, when you listen to these companies, they're definitely calling that out. We heard that in McDonald's. The lower-end consumer is not spending as much. They're a lot more cautious. They're not in that strong financial position. Where the spending is going on, especially when you relate to travel and some of the experience, is coming from the experience economy. It's coming from that aging demographic, seniors who have a lot more in their retirement accounts with the strength we've seen in the financial markets over the last few years, and just overall savings. Now, the question, Shonali, gets back again to this, which is all these actions that coming out of the Washington, D.C., how does that play into and impact the lower end consumer? And at what point this lower end consumer already feeling the pain it becomes too much, and that becomes a magnitude where it starts to impact other segments and other business as well. We don't know yet. It's too early to tell, but it's definitely something that gives us a lot of caution. And we do think that we're not in that position where, the consumer is flourishing by any means. Yes, pockets of it, consumers are, but not in aggregate.
All right, Nimrit, great having you on the show. Thanks, and I hope you can come back soon. Nimrit Kang there of North Star Asset Management. Just looking at the dollar index, it's so weird to see it down. Well,
Yeah.
it was in the.
That helps.
It made a U of our J screen there. All right, coming up, Cisco shares soar, Reddit in the red. We'll take a look at what both tech companies can expect next. This is Bloomberg.
All right, it's time now for Top Calls. Some of the analyst action in focus this morning, and we start with Gordon Haskett saying that Target is no longer a buy. The analyst says that the uncertainty around tariffs and interest rates will weigh on its outlook, also downgrading Macy's for that same reason. Next up, DZ Bank is upgrading Coca-Cola to a buy after it beat on profit expectations. Coca-Cola has been largely unscathed, even as budget-conscious shoppers pull back on supermarket purchases. And finally, we have Cisco getting raised to a buy over at Rosenblatt Securities, the networking equipment company boosting its full-year revenue guidance. Also, the analyst citing its AI potential. Shares currently up about 3%.
All right, let's get some more on Cisco right now. We're joined here at the desk by Mandeep Singh. He's a senior technology analyst at Bloomberg Intelligence. And Mandeep, talk to me first about, for those of us who remember the dot-com bubble, right? How has this company changed from a maker of routers that, enables the internet to a company that hopefully can ride the AI wave going forward?
Yeah, I mean, look, they've made a bunch of acquisitions along the way, some big ones. The most recent one was Splunk, and they have branched into software more and more. But in this case, I mean, the guide and, the revenue raise was more around networking, and it's consistent with what we have heard from hyperscalers this quarter around raising their CapEx guide. So it's clearly trickling down to all the suppliers of that gear, I mean, beyond NVIDIA. And look, I would say Cisco is still not the bellwether it used to be. So even though, we saw a clear beat and raise, I would still look up to NVIDIA to kind of tell us the true picture around what the AI potential is going to look like for this year.
One other potential problem for Cisco is the government spending aspect of this. If you have the government planning on spending less generally, is that going to be a problem for Cisco when networking is such a big part of their story?
It could be. I mean, but when I look at, some of the projects that are impacted by DOGE, I don't really think it's going to trickle down to networking that soon. And given AI is a high priority, I would be surprised if, a company like Cisco gets impacted.
So Cisco shares having a good day. I want to talk about Reddit, though. I've been a power user of Reddit since about 2011. It's had a fantastic run since its IPO, up more than 400, nearly 500%. But coming back to reality a little bit today, it seems like user growth not exactly impressing.
Yeah, especially anytime you're an internet company that misses on your daily active users, that is never good in terms of stock reaction. But look, they're walking a very tightrope here because a lot of these LLM companies are using their data to train their models, and the chatbots are answering a lot of questions based on Reddit data. So it's in this case, Google just made a slight tweak to their algorithm that ended up impacting the traffic that was going to Reddit. So I think that's where, yes, the kind of the data sales is a positive, but then if the traffic gets impacted, it's going to hurt the user metrics. And they are reliant on Google for almost 40% of their user traffic.
And by the way, ChatGPT isn't sending you to Reddit the way Google does.
No.
So the future doesn't look bright for that. For that use case.
For what it's worth, we are still more than $40 above where it was trading on its first day of trading. So still a darling, but little change for Google, big change for Reddit. Mandeep, thank you so much for joining us. That is Mandeep Singh of Bloomberg Intelligence. We're going to have more on Reddit with the company's COO, Jen Wong, on Bloomberg Technology at 11 a.m. New York time. Now stick with us. Up next, the Wall Street Beat. This is Bloomberg.
Welcome back to Open Interest. Taking a look at stocks right now. Of course, the S&P 500 briefly erased gains. Now we're back in the green, but those pre-market gains that we were looking at coming in a little bit. The S&P 500 still up about 0.1%, 0.3% if you take a look at big tech faring a little bit better here. And the Russell 2000, the small cap, still hanging on to that lead, though it's diminishing slightly. But the Russell 2000 currently higher by about 0.5%.
And it's time now for the Wall Street Beat. QRT, a London-based hedge fund spun off from Credit Suisse, is emerging as a powerhouse in the hedge fund industry. The fund has gone from $800 million to more than $23 billion in 7 years. And it's a rarity to see that kind of growth in the $4.5 trillion hedge fund industry. Bloomberg's Nishant Kumar reported on this secretive hedge fund. He joins us now. One aspect of this that I find the most stunning is the culture, because this has been an era of star hedge fund traders, $50 million payout packages. And in this case, you see a shunning of that star culture. Why do we see that, and is it working? Does it set a standard for the future?
Well, it's a more collaborative culture. That's how the company was conceived and has progressed. It's all about team, not individuals. Payouts are not linked to, it is linked to your performance, but it's not that you will be getting a certain percentage of performance, which is the standard at pod shop, what we call pod shops. So QRT is kind of a multi-strat which invests and performs like other multi-strats, but it's not siloed, and we cannot call it a pod shop.
I love this story, Nishant. And the first paragraph, under a low gray sky, a building site sits exposed amid the barren beauty of Iceland in winter. You got to think about writing a novel, honestly. But this...
On hedge funds, yes.
On hedge funds, exactly. Well, secretive hedge fund gets my attention, too. Why secretive?
Well, that's how they have grown. They were part of Credit Suisse, and there also few people know about them. So they were not talked about, not discussed, and potentially because they were insanely successful within Credit Suisse as well. So you don't want your secret sauce, you don't want your best performers to be exposed to the market, and they have maintained that culture. The same team, the same 14 partners who started the firm are still there at the firm. The same 5 largest backers of the hedge funds are still loyal. They have topped up their capital, their cash to the hedge fund. So, they have never kind of needed to advertise themselves. They have grown quietly and big, very big. This must be the least known large hedge fund in the world right now.
Well, Nishant, to that point, you talk about this rapid rise to the top 1% from the unknown. It's rewriting the narrative here. How often do we see someone just take off like this? Is this a rarity?
Very, very unlikely. It's fast and furious. I cannot think of another firm which has grown so quick, so fast, and so big in the hedge fund industry. And we have to also see in what kind of environment. Over the last 10 years, we have seen large hedge funds getting bigger. The likes of Millennium, Citadel, D. Shaw, really dominating the market. They have hoovered away every person that can be hired, and they are looking for more. They have convinced people who wanted to start their own hedge funds not to do that and join them. Mm-hmm. I'll go a step further. They have persuaded people who ran their successful hedge funds to shut that down and join them. And in this environment, there is a player which has grown so fast, so big, with 1,400 people. That's quite rare.
Nishant, great story, among the most read on the Bloomberg as well. Bloomberg's Nishant Kumar talking about QRT. Coming up next hour, Kathy Bonjanchik joins us. This is Bloomberg. 30 minutes into Thursday. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld.
Coming up, stocks are looking to get some relief as investors look past producer prices data that echoed yesterday's hot CPI reading.
President Trump says today is the big one. The president announcing reciprocal tariffs without giving any details on what, how, or when.
And on the earnings front, Robinhood's revenue doubled thanks to a surge in crypto trading. CEO Vlad Tenev joins us later this hour. All that and more coming up. Let's go look at these markets right now. You can see the S&P 500 reinvigorated, now up 0.3% on slightly higher volume than normal. The S&P or the Nasdaq 100 Big Tech also building on those gains that we saw in the first half hour of trading, higher by about 0.5%. The bond market still is the head scratcher here. I don't really understand why yields would fall in response to hotter than expected PPI and a big revision as well. But still, bond yields down about 6 to 7 basis points on your 10-year Treasury yield, currently sitting at 4.55%. Matt Miller.
Well, the good news is we have someone we can ask about that.
Yeah,
right now. Kathy Bostjancic joins us right now, Nationwide Mutual Insurance chief economist. And Kathy, it's interesting to watch these moves. Obviously, one day does not a trend make, and January is a sort of special month to look at inflation figures because a lot of companies naturally reset prices at the beginning of the year. But what do you think about CPI that we got yesterday, PPI that we got today, and the fact that we're still only at 4.56 on the 10-year?
Yeah, good morning, Matt. Lots of interesting dynamics there at play. So, I mean, just big picture takeaway from us is that the inflation data support the view the Fed's on hold for longer. Actually, prior to the CPI data, and even prior to hearing Chairman Powell, we had pushed back the timing of the next rate cut to the fourth quarter of this year, and it could even be later. Inflation's running higher than expected now, and of course there's the prospect of tariffs pushing inflation up even higher. So, and there's lots of uncertainty, so it makes sense for the Fed to go to the sidelines. But digging into the details and like net, what do the CPI, PPI data imply for PCE prices, which is the Fed's preferred measure, we think it's going to be pretty firm and a bit too uncomfortable for them. 4/10 total, 4/10 core. Now, for the bond market's reaction, so we sold off a lot yesterday, which makes sense. But we had all these revisions, seasonal adjustments, and as you noted, even with PPI came in hotter, but it's the beginning of the year, and probably these type of monthly increases are most likely going to moderate. But that said, inflation is still sticky at this point.
So I hear what you're saying. Take it with a grain of salt. Inflation does seem to be sticky here, though, and it seems like the bond market agrees with you, pushing out the timing of the next Fed rate cut to December. But Kathy, it was interesting. We were listening to Mohamed El-Erian on BTV yesterday morning saying that if the Fed really believes in this 2% target, then the next move actually should be a rate hike. What do you make of that argument?
Well, it's certainly picking up some attention here and chatter, and time will tell. I think, one, again, these numbers are coming in higher. They're not likely to persist. Some of it is beginning of the year increases. Now, seasonal adjustment factors should account for it, but they don't fully. They don't do a perfect job of that. And also with the tariffs, yes, it'll, potentially push up the rate of inflation this year, but the next year those come off, assuming we don't get renewed, tariff increases every year. So I think, the jury's out yet. You have to wait and see. But yes, Mohamed makes a great point. If they're really, really stuck on strictly getting to 2%, it does raise some questions about how restrictive policy is. Well, but my sense will be they will. The last thing they'll do is raise rates. They would try to just keep them at this elevated level for longer.
Is it silly for me to remind everyone that they want to get to an average, a long run of 2%, Kathy? And since we were running at 5, 6, 7% for a while, we need to be running well under 2 for years if we really wanted to get to a long run average of 2%.
So great point. I mean, there's a few things there. One, it depends where you start the clock on that, right? If you go back further, we were well under 2% for a long time. But your point is well taken. But they're also reviewing their framework, right? The Fed's operating framework. We'll get the final details of that by middle of the year. They're going to still hold on to 2%, but there'll be some changes in how they view that. So I think that will be important. But I think, at this point, the Fed is also, they see growth is stronger than expected, but there is this uncertainty of how that can persist going forward.
Kathy, I want to do something and go back to what you were talking about when it comes to tariffs. Yes, the jury, of course, is still out because a lot is still uncertain. If you pull up ECTR on the Bloomberg terminal, you can take just a look at how steep the deficits are between China, Mexico, and Canada in that order, where the deficit is the largest among those three. How important, is it important at all for the U.S. to be closing that gap? And what kind of difference does it actually make at the end of the day?
So it is complex how to view this as part of the overall economy. You also actually have to bring in the deficit. So what's happening with borrowing on the government side, matters. And you could argue, many do, that the capital flows associated with our deficit swamp these trade flows. So if you just look at the capital flows, look at what's traded every day in the foreign exchange market, for example, and how many foreigners are buying our bonds, right? That swamps these trade flows. So I'm in the camp that, we need to get our fiscal house in order, and then that would be, more important than worrying about the trade deficits. But that said, there are reasons that maybe you would want more of an industrial base and manufacturing. People have been hurt by globalization, technological change. How do we help that? And there's this argument: should we have some industrial base here as an economy? Is that important? And it could be that for certain industries we should.
Well, Kathy, as we think about, our trade relationships and we count down to that 1 p.m. press conference where we'll theoretically get more detail on reciprocal tariffs, weigh in on the simple question of whether or not tariffs are inflationary. We were having that debate with Jim Caron about an hour ago, and his answer was, it's complicated. I would love to hear yours.
Well, I sat next to Jim many years at Merrill Lynch, so I would agree with him. It is complicated on how you look at break this down. So on one level, it could be that the exporters to the U.S. Eat some of the cost of the tariffs and they shrink their profit margin. Then there's the next layer. You pass it on to the U.S. importer. So companies have to decide, well, do they pass it on to the next level of production of consumers, or do they shrink their profit margins? But if you look back, and what happened in 2018, look at the data and research. Actually, almost all of it got passed on to the U.S. consumer. So my concern right now is it does get passed on to the consumer, and a pretty significant portion of it.
Kathy, we thank you for joining us today, breaking down a lot of complicated issues here. Kathy Bastianczyk of Nationwide. Now, coming up, SS&C Technology is having a great start to the year after their latest earnings report. We're going to speak to the CEO of the financial software company next. This is Bloomberg. SS&C receiving a number of price target increases on Wall Street after the software company beat earnings estimates last week. SS&C provides technology for over 20,000 financial service organizations. It has an enterprise value of roughly $25 billion. Joining us now, Bill Stone, SS&C chairman and CEO. You look at the environment for financial services, a lot of people getting excited about the prospect of deregulation. There are reports out there about potential consolidation of regulatory bodies, agencies in the United States. When you talk to your clients, what does it look like under the surface in terms of that churn, preparing for all of that change?
Well, you know, markets are open every day too, right? So as much as they're worried about what they're going to do, they got to worry about what's today. You know, and a lot of our clients are big financial institutions, and we have, you know, tons of hedge funds and private equity funds and every other private type of fund. So, you know, they're all trying to prepare for, you know, what do tariffs really mean? You know, what is bluster? What is real? You know, and trying to decide in a wise way how to take advantage. You know, and I don't think it's necessarily clear. It's kind of foggy, right? So I think that you know, the smartest ones, you know, don't dive in. They start nibbling around the edges and then deciding which one looks best, and then they might go in heavier. But it's never flippant. You know, it's never, well, they're going to go so fast. No. They're very thoughtful, and they're very, you know, they might think faster than us.
Right. But, you know, the fogginess is something I want to double down on, because in the commercial break, we were talking about those animal spirits underpinning these markets. Is that at risk with a lot of change coming ahead?
Well, I think, you know, with change is what gives people opportunities, right? So you youngsters could go start a hedge fund, right? And now you're not in that side of the business, but a lot of these young gentlemen and ladies that are, you know, in their early 20s, 25, 26, 27, you know, they can go start a fund, and if they can raise money and they can have a great strategy, maybe get a little lucky, you know, they can have some good performance, then they'll get more money, you know, and then they'll get smarter people to come work for them, and that will start that engine, you know. So, you know, we're lucky enough to get a lot of the people that spin out of the big multi-strat funds like Millennium or Citadel or the other ones, and you know, like Bobby Jane, I think, just did it this year, and you know, I think he had the biggest launch of the year, and he really bright guy. I mean, didn't 24, really bright guy, and you know, he now manages excess of $5 billion.
My question is, on the optimism of these animal spirits, right? Optimism, basically, for people in the market. And you have a fantastic seat from which to judge. Yesterday we got, I think the NFIB was or day before yesterday?
3 days ago. Mm-hmm.
3 days ago, thank you. And optimism kind of fell a little bit because uncertainty is rising. And I think you were kind of asking the same thing, right? Are we at risk of all of this uncertainty stymieing the optimism that you hear from your clients?
I don't think so. In other words, you know, like him, don't like him, you know, President Trump is doing things, you know, and that gives people optimism that maybe America is going to lead the world again. And I think in general, that's a good thing for the world, you know, and it's also a good thing for our markets and for other people's markets too. So I think, you know, we are kind of the beacon, you know, and I think that's a good spot to be in.
I want to talk a little bit more specifically about your business and specifically about your stock price, because I was just checking out shares. Obviously, the reaction to last week's earnings report was extremely positive. You're trading at an all-time high right now. We were talking about the optimism on the regulatory front. There's a lot of optimism about M&A. Is that something that you're thinking about right now?
Well, we've done 76 acquisitions. You know, I'm the founder of SS&C.
So you like them?
We like most of them, you know. But, you know, it's a lot of work. And in today's market, you know, the prices are high, right? So you got to be extremely, you know, thoughtful when you do acquisitions. And what are you going to pay? And what interest rate are you going to borrow at? And then, you know, how quickly can you get synergies if that's a key part? And so, yeah, we like M&A. And we think that, you know, maybe the administration will look favorably on M&A, some of the consolidation you talked about, you know, versus the prior administration wasn't too big on M&A.
All right, Bill, really great to get some time with you, especially in studio. Hope we can talk to you again soon. That is Bill Stone of SS&C Technologies. Now, still ahead, Trump vows reciprocal tariffs today. We'll bring you the latest out of Washington next. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. President Trump and Vladimir Putin have agreed to negotiations over a settlement to the war in Ukraine. The move doesn't appear to involve Kiev in the negotiations, reversing 3 years of U.S. policy. European allies worry the more the U.S.'s stance could amount to selling out Ukraine and handing a giveaway to Russia. Defense Secretary Pete Hegseth defended, though, the president at a NATO meeting, calling it no betrayal of Ukraine. Meanwhile, Hamas says it will free hostages on Saturday as scheduled. At least 3 Israelis held by the group are set to be released in the next round of phased exchange for hundreds of jailed Palestinians. Hamas had previously threatened an indefinite delay in the swap that threatened to derail the entire ceasefire. And job cuts at Chevron and Blue Origin. The oil giant plans to cut its global workforce by 15 to 20% by next year as part of its efforts to bring down costs and raise profits. And Jeff Bezos' rocket firm is bracing for a large reduction in its workforce after years of expansion. That company is looking to focus resources on ramping up rocket launches after years of R&D work. President Trump says he would announce reciprocal tariffs, or will announce reciprocal tariffs today at 1 p.m. Eastern time. He's promising to deliver on his threat to slap tariffs on imports from countries that impose higher duties on U.S. goods than we do on theirs. The move would represent a major escalation of his trade war with economic partners. He didn't give any detail on what the tariffs would be on, or how they would be structured, or when they would take effect, but apparently that's what we're going to get Katie, at 1 p.m.
Yeah, so stay tuned. Let's try to get some detail now with Mike Shepard joining us from Washington. The latest reporting coming from CNBC is that the Trump tariffs will not go into effect today, that they'll have a delay. They may start April 1st. This is according to CNBC reporting. The S&P 500 currently higher by about 0.5% at session highs, Mike, seemingly in response to this news. But I guess if you view these tariff threats as negotiating chips, that maybe the fact that they wouldn't start today isn't necessarily surprising.
No, it isn't. And also there is the complexity factor, too, because when you think about the steel and aluminum tariffs that he unveiled and that will take effect next month, and the tariffs that he threatened and then pulled back against Canada and Mexico, those were a little bit monolithic. But what Donald Trump is trying to do here is to even things out. That is, they charge us, we charge them, in his own words. But if you think about the vast array of products coming into the U.S. and that the U.S. is exporting abroad, it is a much more complex picture. And trying to track down all the different duties and other possible trade barriers that might be in the way could take a little bit more digging by agencies like the U.S. Trade Representative, by the White House, and the Department of Commerce. So the CNBC report, which we haven't confirmed ourselves, does make sense on a lot of fronts. And you're right, Katie, as well. Donald Trump is looking for negotiation leverage with other countries. And interestingly, within hours after this 1 p.m. news conference, he is hosting Indian Prime Minister Narendra Modi at the White House for a long-awaited meeting with a close ally. And yet his country is also potentially subject to heavy hits from these reciprocal tariffs.
Hey, I'm looking at, things that other countries tariff more than we do. Autos is first. I've been thinking about this for decades, Mike, because the EU puts 10% tariffs on our passenger vehicles, and we only put 2.5% on theirs. But also dairy. The EU tariffs us highly on dairy, more than we do on their dairy goods, and meat. Are those some of the things that you're focused on as well?
Those would be the top targets for Donald Trump, and in particular, the European Union and autos has been a particular bugaboo for the president. Even during his first term, it was something that vexed him, and it caused a lot of friction between his administration at the time and the European Union. So this is very much a driver here. And likewise, you brought up meat and dairy. Those are two industries in the heartland that, were behind Donald Trump's candidacy. So we'll look for how that plays out. But again, as I said, this will take a little bit of time to implement, and it will be interesting to see how these individual sectors actually get affected.
I want to switch gears a little bit, because as we're talking about the relationship between the United States and the rest of the world, we also have to acknowledge the conflict that's going on, not only in Ukraine, but also the broader Middle East as well. Let's start with Ukraine, because you do have a sense here that, according to our reporting here at Bloomberg, that the President Trump is trying to push for elections here in Ukraine as well at a very vulnerable time. How is this going to complicate the relationship that the U.S. has to what is happening in Ukraine?
Well, it is a very quick turn of events, almost a 180 in terms of U.S. relations with Ukraine. For 3 years under President Joe Biden, we saw the U.S. stand by Ukraine. Joe Biden was responsible for really rallying Europe and awakening them to the threat that Russia might invade, and then organizing a lot of support, including from Europe, but as other allies, and of course the U.S. itself, in supporting Ukraine's effort to try to repel Russia's invasion. And there was really unstinting support for the Ukrainian President Volodymyr Zelensky. Keep in mind that elections have held in abeyance in Ukraine since the war started. So presumably after any kind of settlement with Russia, Volodymyr Zelensky could be on the ballot once more. And Donald Trump yesterday was hinting that maybe his popularity at home wasn't as strong as maybe it appeared, and that it could be a challenge for him electorally after any kind of settlement. So this is undermining, in a way, the current president in Kyiv. And we're also seeing this effort to maybe box Ukraine out a little bit from negotiations with Russia over a possible settlement. Now, Joe Biden had made it U.S. policy that there will be no discussions separately with Russia without Ukraine. So this is a big change here.
Mike, we thank you so much for your time and your reporting. That is Bloomberg's Mike Shepard on all that is going on in Washington. I also want to switch gears, bring you over to an IPO of the day. Of course, we're looking for the opening of SailPoint. The shares are indicated to open at $22 a share. The IPO price was $23 a share. This is another test of the IPO market. Of course, this is a private equity-backed firm, Thoma Bravo, looking to take the firm public. But of course, if they don't see that pop, let's see how much appetite there is for the IPO market of this kind of
Right. It'll be
security.
interesting to see the reception there. We're speaking to the CEO next week as well, which I'm looking forward to. You take a look at markets right now, the S&P 500 at session highs. SailPoint shares now indicated to price at $22 each. This is Bloomberg.
Now another stock we're watching today, Robinhood. The stock is jumping after reporting topping estimates in its fourth quarter report. Its revenue beat powered by a 700% jump in its cryptocurrency revenue. The company also announcing it expects double-digit revenue growth this year. Joining us now, Robinhood CEO Vlad Tenev, $1 billion in revenue for the first time as a public company. So clearly a great quarter. The stock is responding to it. I do want to talk, Vlad, about some of the growth initiatives, some of the newer initiatives. You launched derivatives businesses that have been very much expanding, event contracts. What can you tell us about how well they're doing into 2025 that would signal these businesses becoming a bigger part of Robinhood moving forward?
Thanks, Shonali. Glad to be here. Yeah, it was a strong quarter, but the job's not finished. And one of the things we're most excited by is that there's a full packed roadmap. It's going to be an intense year, and we're going to make progress across all three of our strategic priorities. You mentioned the active trader front. Robinhood Legend, which we unveiled a couple of months ago, which is the first desktop platform that we built specifically for active traders in mind, that's already off to a fast start. That's up to $50 million in annualized revenue after just 2 months of being live to customers. And we expect that to continue to accelerate as more customers adopt the platform and we keep making improvements. The team's been shipping features on a weekly basis and iterating extremely quickly. The feedback's been very, very good. Index options, we already announced, is up to a $15 million annualized revenue run rate, and that product just went live in the past few months as well. And not to mention our derivatives business with futures and a comprehensive prediction markets event contracts offering that are rolling out either now in the case of futures outrights,
right,
but in the next few months for the comprehensive event contracts offering.
Well, Vlad, that's exactly where I want to go, the events contracts business. Before we get to the ambitions, I want to actually look backwards and talk about what happened with the Super Bowl, because you launched those Super Bowl events contracts. They were live for about a day, I think, and then they were pulled at the request of the CFTC. You said that you were in contact with the CFTC beforehand. What actually happened there? Any light you could shed would certainly be interesting.
Yeah, of course. And I should say that we're huge believers in prediction markets. We think they're the future of trading and also the future of news and information. So I've been a student and a fan for a long time, and that's one of the reasons we're so excited about bringing a larger comprehensive event contracts offering to our customers. You probably remember in November of last year, we launched the presidential election market, which allowed our customers to trade the election. That was our first event contracts offering, incredibly successful, over 500 million contracts traded in just about a week. We did follow that up with the Super Bowl last week. And yeah, I mean, the CFTC had issue with that rollout. They asked us to suspend the rollout, which we complied with, even though, I mean, it was a little bit perplexing to us that several companies were allowed to continue offering those to consumers. So we're going to have to continue to work through that. And we believe in these products. They're coming, and Robinhood is going to be a big part of offering those and also driving regulatory clarity to make sure that these products that are so useful and available to institutional consumers make their way to retail as well. So TBD, you know, but I think you should expect us to be a leader in this innovative space and continue to push for clarity from regulators there.
Well, Vlad, just to sate my own curiosity, it was live for about a day. Did it actually generate any meaningful business, or was it too fresh?
We pulled it back after it was rolled out to a small percentage of customers. We did get some early signs on whether customers would be interested in it, and particularly how they would feel about it being alongside other tradable assets like futures, options, equities, and crypto, because now Robinhood's a comprehensive, diversified platform. So the signals were good. Obviously, customers are interested in these products, and that makes us very, very optimistic for delivering a comprehensive events offering later this year.
Well, you know, now you have a new CFTC, or at least that CFTC is no longer the one you're going to be dealing with. In that light, Vlad, I'm sure that you attempt to be the best business that you can regardless of the environment, but different environments offer different opportunities. So what do you see as your advantages now in you know, Trump's new sort of golden era, golden age that he wants to drive?
Yeah, I mean, I think a lot of people focus on crypto, and we're certainly going to be in a more innovation-friendly environment in crypto. I think that's going to be a tailwind for our business as one of the few scaled players in both crypto and traditional financial assets. But Robinhood's at the forefront of innovation in financial services in a few key areas. Artificial intelligence is coming and is going to disrupt financial services in a big way. We talked about event contracts and prediction markets, and that's a huge innovative new product, and that's going to be a new industry. We're at the forefront of that. And so it's great to see an innovation-friendly regime that's coming in that believes that the U.S. needs to be number one in business and innovation. And I think that'll be good, not just for Robinhood, but for every industry we operate in.
Speaking of innovation, this whole move to 24-hour trading, one way you have told investors now you're facilitating that is partly through using stablecoin to power settlements. How far does that go, and how else can you be using stablecoin to make your business more efficient? Does that just take off once you have greater U.S. rules around this?
Yeah, so we're part of the U.S. Dollar Global Network, USDG, with a couple of other great companies. And the idea that we want to introduce is that in order for stablecoins to be competitive with other means of holding and transacting in dollars, there needs to be a better way to pass yield directly onto holders. And right now, in a high interest rate environment, you could be getting 4% yield on your cash in a bank. So if it's not easy to get the same type of experience with stable coins, then they're not going to be as competitive. So that's the real innovation that we're driving, making it easy to do that. Now, in terms of use of stable coins for institutional purposes, one of the things that we have to do to operate our crypto platform is facilitate transactions and settlements between cash and crypto 24/7, particularly on weekends when the banks are usually not open and there's no way of transmitting dollars using banking rails on weekends. Stablecoins solve that problem because it's a 24/7 network that's running on software. And I think that just shows you just one of the advantages of crypto technology over the traditional financial system. And that translates not just to money movement, but also to trading, to liquidity pools, and to the trading of private assets that are typically considered illiquid.
Speaking of private assets, a lot of things that are trying to be done in the private assets world is tokenization of private funds. You've been talking about tokenization as well. You told investors just last night that it's something that you're perhaps most excited about. How big of a business could that become for you? And what are the near-term plans to make tokenization a serious part of what Robinhood does?
Yeah, so I think the near-term opportunity that everyone's excited about in the U.S., provided we get some regulatory clarity on this point, is being able to put real-world assets on blockchains. And I think what resonates with customers in the U.S. is private company stock. So I think it's ludicrous that, customers are free, retail's free to invest in, a wide collection of meme coins and other alternative assets, but OpenAI and SpaceX and other private companies that early backers have seen, 100x, sometimes 1000x or more returns are impermissible and are seen as too risky. So I think that needs to change. And I think over time, what you'll see is if we release the power of crypto technology and allow crypto to be connected to real world assets like securities, the addressable market for that is every private and public listed equity, which is obviously trillions of dollars in market value. We see crypto as the next stage in the technological advancement. We've gone from, filing cabinet to mainframe to on-premise to cloud. And I think the next stage of evolution is going to be the financial infrastructure going from cloud to crypto technology. I think Robinhood's best positioned to actually lead that transformation.
Vlad, we only have about a minute left, but you brought up meme coins. And I'm curious about that because compared to maybe some of your competitors, compared to Coinbase, for example, when it comes to meme coins, it seems like you've submitted fewer requests to regulators to list those coins than Coinbase, for example. Why is that? And do you see that strategy changing maybe under this new regulatory regime?
Yeah, historically, we've been extremely selective about the assets that we list on the platform. I think now we're in a world where, on some of these chains, including Solana, there's hundreds of thousands or more new coins created. And I think that's really interesting. On the one hand, it raises questions for what it looks like to list assets and what the policy should be to make it available to retail freely through these centralized platforms like Robinhood. I think we need clarity on that. On the other hand, it kind of shows you the power of this technology and what an improvement it is upon the existing IPO process, which is so long and cumbersome that a lot of the best and biggest private companies are choosing to delay or forego it entirely. So that's why I think it's so interesting to connect crypto technology with real world productive assets, because all the benefits that you get can accrue to customers that want to trade those revenue generating productive assets.
Vlad, great having you on the program. Really appreciate your time. Robinhood CEO Vlad Tenev there talking to us about driving his business forward. I want to quickly break some news here. We talked about this earlier, but some job cuts at Blue Origin. Jeff Bezos' space company going to cut 10% of its workforce. This according to people familiar with those cuts.
I also have some breaking news here over at Morgan Stanley. Matt, this has been an incredible turn of events. After years of having a hard time offloading X Holdings debt, they are now aiming to boost the size of the latest offering, marketing a $3 billion portion of the debt that may price with no discount. Also offering more breaking news as well here. Bloomberg Scoop now getting a little further down the road. Elliott is pushing big cost cuts over at BP to preserve its independence. We are looking at Elliott management pushing BP to improve capital allocation and pushing big cost cuts at BP to preserve that independence. You are watching shares kind of fluctuating today, still down on the day, Katie.
The X-Debt Morgan Stanley scoop is really interesting. What a story to follow. We know that there's been reporting that they've been offering sweeteners when it comes to offloading that debt. Seems like something is working, though.
Right, absolutely. And remember, this is something that years ago we were talking about Morgan Stanley potentially losing a lot of money on this. And now you have hedge funds apparently lining up out the door to get in with Elon Musk.
With sweeteners.
With sweeteners.
Lining up, but sweeteners necessary to get them online, right?
Absolutely.
Those are two conflicting pieces of information, but we'll sort it out here for you. Stocks continue to rise and are going further and further into the session. This is Bloomberg.
It's time for our daily Wall Street Week conversation. And as we just discussed with Vlad Tenev, Robinhood dipped its toes into the prediction market last year, letting users bet on the outcome of the U.S. presidential election. But the platform rolled back events contract that would have let users bet on the Super Bowl following a request from the CFTC. Bloomberg Wall Street Week host David Weston takes a deep dive into why so many investors are betting on prediction markets.
Event contracts are basically yes or no questions about upcoming events. And people form various opinions and expectations about them. And we ask them, what do they think the probability is that the event is going to happen or it is not going to happen? And we ask that in the way where we say that you can buy a yes or a no answer, and if you are correct, we will pay you $1. So therefore, the appropriate price for buying a yes or a no is the probability that the outcome will be the yes or the no.
Thomas Petterfee is the founder of Interactive Brokers, a brokerage firm that launched its own prediction website last year called ForecastX.
ForecastX currently deals with climate questions, economic indicators, political questions. In the future, it will deal with questions having to do with the economy, having to do with cultural developments, having to do with demographic questions, and basically the large questions that people are faced with in their lives.
I think our goal with prediction markets is really to allow every person that has an opinion on something to find that market and that big event that they care about to be able to trade on.
ForecastX isn't the first or the only prediction market in the United States. Founded in 2018 and launched in 2021, Kalshi is the first CFTC-regulated exchange, and it's taken the market by storm. Kalshi's app has been downloaded about 2 million times, and it's seen nearly $2 billion in contracts. Luana Lopez Lara is the company's co-founder and COO.
While we were in MIT, one thing we realized is that most trading happens when you have an opinion about what's going to happen in the future and you find a way to put that in the market. So you think this country is going to go into a recession, or you think this person is going to win an election, or Brexit's going to happen, and you find a way to express that view in the market, to hedge some risk that you have, or also to get exposure to something. And what we realized was there should be a better way to do it. And for us, it was, why is there no direct exchange that you can just trade directly on what you think is going to happen?
And that was Wall Street Week host David Weston. You can catch the full show every Friday at 6 p.m. Eastern. This is Bloomberg.
Risks around the world are ramping up, from geopolitical strife to heavily concentrated stock markets. And that's made it more challenging for investors to navigate the next big risk. I sat down with one of the giants of the private credit market, Jonathan Lewinson of Diameter Capital Partners, to get his take.
The world is teeming with misinformation. It's deepfakes, it's AI, it's hard to work through. At the same time as this is happening, political identity is paramount, which means that people's political affiliation matters to their self-perception more than ever. And that doesn't only mean what their values are for the future, it's about what they think just happened. It's a debate about facts. Wall Street is supposed to be an island of objectivity in all of this. If earnings are good, the stocks go up. If earnings are bad, the bonds go down. But Wall Street more and more is adopting unmarked assets. Private equity, venture capital, private ABF, private credit. Those things aren't marked. Mark to market is what creates the need for honesty. And to me, the next big risk is, in this sea of subjectivity, in this changed environment, will investors really know what they own? Or does everything become Silicon Valley Bank and Lehman Brothers?
How does that make the job of an investor more difficult?
So let's step back first and